The impact of tariffs weighing on economic forecasts and leaving investors cautious ahead of earnings season. We spoke to Matt Orton, Raymond James Investment Management Chief Market Strategist, about his outlook.
I think the catalyst is going to be earnings season, because tariffs are not, I think the biggest uncertainty that investors face right now is what earnings growth is going to look like later this year and into 2026. So I think earnings season is going to bring the focus onto who the winners can be in this environment going forward, because not everyone's going to be able to win.
Joining us now, Stephanie Roth, Wolfe Research Chief Economist. Stephanie, great to have you in studio. You heard there Matt talking about how tariffs might show up in earnings, and we saw tariffs showing up in the data for the first time with that PMI data yesterday. To what extent are you weighing your outlook based on the tariff policy while we don't have certainty at this time?
Yeah, and the certainty in and of itself is a headwind on GDP, right? So base case is that we do get some significant tariff policy. If he goes reciprocal tariffs plus VAT plus sectoral tariffs, now we're talking about a 1.4 percentage point GDP headwind. We're not incorporating all of that. That would be really significant. And as we're starting to see today, there are some negotiations. So base case, you have reciprocal tariffs, which are actually not that big of a deal if they don't include VAT, and we can certainly get into that. Yeah. Sectoral tariffs, which he seems to be pretty committed to, although maybe the timing has been pushed back, which was some of the news over the weekend. Combination of all of that is about an 80 basis point headwind on growth. We're looking for 1.6% GDP this year. So it's about half of what we had last year, but we're still growing. Should still be an okay economy, although notably slower than where we've been.
Okay, so let's break down the significance of the VAT headwind there, which for folks who are just watching at home and trying to figure out, oh wait, we're bringing VATs back into the conversation once again. VATs essentially the value-added taxes here, but why does that matter in the reciprocal part of tariffs that could play out?
Because it's a very significant amount, right? So the VAT tax in Europe, for example, is about 22%. So if you all of a sudden add VAT plus reciprocal tariffs, the differentiation in our tariff versus Europe's tariff is about 3%. So either it would be 3% if we don't include VAT, or something like 25% if we do include VAT. By the way, it doesn't make sense necessarily to include VAT because they're treating US and foreign companies equally. It's not as if it's an unfair trade practice, but the administration seems to feel that way about it.
But how do you, I think it's a great example of the question of how do you model in this environment? Because you talked about in your notes to us that could be a 150 basis point hit to GDP. That's pretty significant. So how do you kind of weigh where we're heading with that big of a question mark?
So I think the way we look at it is, clearly, the administration wants to do tariffs. They believe it's raising revenue. This is something that Trump has talked about for many, many years, about something that he legitimately believes in. Do I think he really wants to tank the economy? No. So they'll probably end up somewhere in between, and that's how we'll end up in this sort of 80 basis point headwind, which is kind of similar to the negotiation that we started with China last time, is they ended up doing tariffs on roughly half of the goods.
What gives you that confidence that the administration is not aiming to tank the economy right now?
Well, of course, it's hard to have confidence in with this administration who's particularly uncertain. And I don't think that necessarily achieves exactly their goal, right? They want to do tariffs. They want to raise revenue. They don't necessarily need to tank the economy entirely to do so. They can achieve their goals in a way that would result in a slightly slower growth, an adjustment type of period, but one that doesn't necessarily result in a very high unemployment rate. So we can achieve all of those things that could get the Fed to cut a little bit more than would otherwise be the case, bring down 10-year yields, and realistically, at the end of the day, we're sitting here in an economy that's slower than where we were, yields are a little bit lower, and you kind of get to the same place without having to have a real painful recession.
While the administration hasn't used the words tank the economy, they have used the words there might be some near-term or some interim pain. And so if we were to quantify what that pain could look like if we're kind of analyzing a range of outcomes and scenarios here, what is the best case scenario versus the worst case scenario from how you're modeling as well?
Best case scenario, you have a 20 basis point headwind to growth. And then the worst case scenario is you have a 2 percentage point headwind on growth. So the way I think about it is if growth was going to otherwise be 2.2%, the best case scenario is we end up with a 2% GDP growth this year, which is kind of trend. 2.2% was our, all else equal before Trump and tariffs. That would have been our GDP forecast before the case. And then if you have a 2 percentage point headwind on growth, now we're talking near recession type of backdrop. So that's the range of outcomes. Base case is generally somewhere in the middle. So you're at that 1.6% GDP, which is just a little bit below trend.
At what point does this question about the soft data start to impact consumer spending and actual activity that we might get more clarity on in more of that hard data moving forward?
So soft data have historically, especially in the past couple of years, have not predicted hard data. So there are times where there are big discrepancies where consumers feel bad, yet they're still spending.
Right.
That was largely related to the inflation that we saw the past couple of years. Consumers felt really bad about the inflation, but they actually had the means and the ability and desire to spend. So it's possible we'll see soft data and the consumer will still be okay. We're starting to see some signs that the consumer is slowing down a little bit. So I would anticipate to see consumer spending also growing at with a one handle somewhere around 1.5%. But the soft data will be an important indication, at least directionally, how the consumers are feeling. So today's data will be important to gauge as the headlines just continue to mount, how are consumers directionally feeling about the backdrop.
And I guess for the Fed, it's how much of that data, and if it does come in softer than expected, how much of that data actually makes a trend that prompts them to make a policy move one way or the other.
Yeah, and for the Fed, when we're thinking about the soft data, the most important thing is going to be inflation expectations.
Yeah.
They care how consumers feel about inflation in the next couple of years, because that's going to be the deciding factor about whether they can actually feel comfortable about cutting interest rates in response to weak growth. Last time they were able to do that. This time they're going to have to watch that. If inflation expectations remain anchored, the Fed is going to be able to be a little bit more accommodative.
30 seconds. What's your favorite economic indicator right now?
Probably claims.
Okay.
Come out weekly, watching them both from government layoff. Claims are reported separately, so watch those separately from the other claims to get a sense, is there some other fallout as a result. As of now, they both kind of look okay. Government claims have risen, about 1,000. We're talking initial claims here, about 1,000 above what they normally are. It tells us that Doge layoffs haven't really happened in a big way yet. And we'll be watching that to sort of gauge whether there is more fallout as a result.
Stephanie, great to catch up with you. Thanks so much for joining us in studio this morning.
Thanks for having me.
Absolutely.